So our group chose to analyze Lowe's. We particularly looked at the January 28th, 2022 10K filing. Our presenters are listed, and you'll hear from all of us today as we all covered a different subject or section. Those sections are broken down here, and we're going to get started with the general information, business overview, and risk factors that I covered. To start out with some general information. So Lowe's Companies is the second largest home retailer in the world, second to Home Depot. They have businesses across the US and Canada. Their stock ticker is LOW. It was founded in North Carolina. So business overview that was given by the Lowe's 10K. So Lowe's kind of broke down their overview by four main categories: customers, market, competition, and products and services. Their customers are broken down into two main categories. That's homeowners and renters that are doing kind of DIY projects, with the second category being, professionals, whether that be construction trades, maintenance, repair, or operations. And they really try to target their sales to those two groups distinctly. Market factors. Lowe's looked at a variety of market factors. They're primarily focused on the US market, with that comprising 90%, 94% of its sales. And some key factors that looked at were disposable personal income, employment, mobility, all things that would affect, home ownership or spending money at a home, improvement store. As far as competition, I mentioned that they're the second largest retailer in the world to Home Depot. So obviously they get a lot of competition from Home Depot. They also see some competition from, mom and pop kind of traditional hardware stores or plumbing stores, as well as professional customers that buy wholesale. And then products and services. They broke their products and services category into two, where they sold their general, in-store brick and mortar kind of products, whether that be, refrigerators or tools, anything like that. And then their installation, repair, and maintenance services category. Their service category, we'll talk about that a little later with their risk factors, but they basically will offer to install some of their products that they sell in store. Risk factors. So risk factors, there's a lot listed in the 10K, but I pulled out a couple big ones here. So they saw a lot of strategic, competitive, operational, and reputational risk. A lot of that came with consumer mobility and how people shop today, which is primarily online. They also saw a lot of risk in implementing new technology into their workforce, where they were trying to use tablets and cell phones for their employees to kind of help the customer a little better. And they were worried about how that would be implemented. The other risk factors were supply chain and third-party risk. A lot of that comes from COVID-19 pandemic and the increases of shipping prices, which has in turn increased all of Lowe's prices throughout. And then the other one was, I talked about their services earlier, their services, operations. Well, they contract out their third-party operations, and that creates a big risk for, legal or returns where there's damages to the, the services that they provide. Say a third party comes in and installs tile that you bought at the store, that can open up a legal or a damages risk to Lowe's that they're very concerned about. And with that, I'll pass it off to my colleagues to address the next section.
So item 7 gives management an opportunity to paint a picture in conjunction with the financial statements, which gives investors and shareholders a more complete view of the fiscal year. For Lowe's, management's broken this down into 4 components. The first 2 that I'm going to present over is the executive overview and operations. Second 2 are financial conditions and critical accounting policies. For the executive overview, the first portion was the 2021 performance, where Lowe's has emphasized their total home strategy. This strategy is basically provides a full complement of products and services for the pro and DIY customers, enabling a total home solution for every need in a home. They've also, for the stores, they've also implemented these perpetual productivity improvement initiatives, which allow for reduced time that associates spend on tasking activities, so they can focus on serving the customer. Looking forward, Lowe's still wants to focus on their total home strategy, specifically in 3 key areas. The first of which is expanding online assortment, which is meeting both pro and DIY customers' designs and lifestyle needs. Second is enhancing the user experience. This is by upgrading visualization and configuration tools online. So a big focus on their websites. The third area is improving fulfillment. Basically, this is for positioning in-stock inventory to meet these fulfillment obligations, such as same-day and next-day deliveries. And then onto the operations section, a couple things I found interesting, one of which was the non-GAAP financial metric, the adjusted EPS. And so this basically takes into account different impacts and excludes these impacts from the calculation of the EPS. So as you can see, it's almost $1 difference adjusted as it was reported, and this is mainly due to a 1.1 billion loss on extinguishment of debt and 45 million cost in upgrading Canadian operations. And then fiscal 2021 compared to fiscal 2020, you saw a net sales increase of 7.4%. These is mainly due to the comparable growth sales increasing 11 of 15 product categories. What increased was these electrical and lumber categories, mainly due to the pro customer demand as well as inflation. And then flooring saw an increase due to new product offering, vinyl flooring. And then one thing I thought interesting was the decrease in these categories was paint, hardware, and lighting, mainly due to the COVID year being the year prior. So that ends my part of the presentation of item 7. Now to the financial statement analysis with Mark.
All right, I'll be going over the financial statement and supplementary data. As Christian mentioned, we saw a 7.4% increase from 2021, primarily driven by sales growth. What I specifically want to cover is what's notable here, which is the repurchase or the stock buyback of about 13.1 billion by Lowe's of this fiscal year, as well as the 2 billion payout in dividends. So going over the consolidated statement of earnings, what's fascinating here is just you see this continued sales increase. This is also continued from 2019, so it's not just a recovery from COVID, rather an overall sales growth. Looking at the asset sheet, the most notable thing here is while you might see a decrease in just total assets, this is actually a return to pre-COVID levels, so it's not necessarily an indication of things going off the cliff. Liabilities, the biggest thing to note here is that Lowe's does continue this trend of just increased leverage on long-term borrowing. And then most notably here on the balance sheet, you do see a decrease in total liability and shareholder equity. This is primarily driven by a decrease in shareholder equity from that $13.1 billion stock buyback I mentioned earlier. Financial footnotes, there is a couple of notable footnotes to cover. Note 1 does go over the impacts of COVID-19, which are lessened, but there's still factors to consider, like the supply chain crisis. They go over their lease assets and what they have in there. They go over their exit activities, and they cover their Canadian restructuring that Christian mentioned. They go over their debt, and they go over in great detail their long-term debt. They go over their earnings per share and how their earnings per share has increased to about 55% from 2021. And then they go over their commitments and contingencies, and they specifically go over this $1.6 billion non-cancelable commitment that they have.
Okay. Now I'm going to talk about the ratios. The current ratio indicates a company's ability to meet short-term debt obligations. Lowe's has a very low current ratio. However, it is right in line with its competitors. The quick ratio is a measure of the company's ability to meet its short-term obligations using its most liquid assets. A higher quick ratio signals that a company can be more liquid and generate cash quickly in case of an emergency. Lowe's is well below the industry average. Gross profit margin is the ratio of gross profit to sales revenue. There's been no change between 2021 and 2022, and Lowe's is right in line with the industry average, so there's nothing notable there. Return on assets is a financial ratio that shows the percentage of profit that a company earns in relation to its overall resources. A low ROA indicates that a company is not able to make maximum use of its assets for getting more profits. Lowe's is only slightly lower than the industry average, which is a good sign. Return on equity is the amount of income returned as a percentage of shareholders' equity. If a company's ROE is negative, as Lowe's is, it means that there was a negative net income for the period in question. This implies that the shareholders are losing their investment in the company. While this may look bad, there could be a good reason for losing money, and ROE can often be misleading. As you can see, in 2021, the ROE was 406%, whereas now it is negative. The debt to equity ratio is a financial ratio indicating the relative proportion of an entity's equity and debt used to finance an entity's assets. If a company has a negative debt to equity ratio, this means it has negative shareholder equity. In other words, the company's liabilities exceed its assets. In most cases, this would be considered a sign of high risk and an incentive to seek bankruptcy protection. Generally, a higher total assets turnover ratio is favored because it implies the company is efficient and in generating sales or revenue from its asset base. A lower ratio indicates that a company is not using its assets efficiently. The asset turnover is increasing for Lowe's, which is a good sign. Again, a higher number for receivables turnover is better. However, Lowe's does not have an account receivable, which is why this is blank. Inventory turnover measures how often a company replaces its inventory relative to its cost of sales. Generally, the higher the ratio, the better. A low inventory turnover ratio might be a sign of weak sales or excessive inventory. The interest coverage ratio is a measure of a company's ability to meet its interest payments. If a company has a low interest coverage ratio, there's a greater chance the company won't be able to service its debts, putting it at risk of bankruptcy. Lowe's is below the industry average, which is a bad sign. However, as you can see, Lowe's is performing under average in comparison to its competitors, but it is displaying a similar performance to Home Depot, which is its main competitor. Now I will turn it over to Ronnie.
We're now going to look at the common sized analysis. So primarily, we're going to look at the balance sheet categories in comparison to the total assets. Current assets are roughly 45% in comparison to total assets, while current liabilities are roughly 44% in comparison to total assets. This is why the current ratio that Mackenzie showed us is hovering right around 1. In 2022, total stockholder equity dropped by roughly 14%, largely due to stockholder buyback. Turning to the trend analysis, here we also see that current assets in 2022 dropped from 2021 while liabilities increased. Notably, long-term debt, excluding current maturities, increased by roughly 15%, which is driving that negative stockholders' equity that we're now seeing in 2022. Both common size analysis and the trend analysis show Lowe's worsening financial position from 2021 into 2022. This slide, I think, is really interesting. These numbers are from Lowe's most recent financial outlook to investors. So from 2021 to 2022, we're seeing that return on capital invested increasing from 33% to 35%. For comparison, the last 10 years of the stock market has been roughly 15% according to S&P Global. So this is a really insane return on capital invested that Lowe's is toting. They're also holding their capital expenditures and share repurchases flat from 2021 into 2022. And this is Lowe's trying to show their investors that they have capital discipline. And then key concluding points, Lowe's is performing under average in comparison to competitors. And this is what Mackenzie highlighted in our ratio comparison to competitors. Home Depot is displaying a similar performance to Lowe's. Their ratios are almost identical to Lowe's. Lowe's also had an increase in sales since 2019, and since this is happening since 2019, this increase is a true growth in sales and not just indicative of COVID. Lastly, as a group, we prefer Lowe's over Home Depot based on their elevated shopping experience and their quality of products. Thank you.